Awesome, awesome, awesome. This is so good. Very rarely does a founder get a chance to ask questions to investors. So I think that's a good start already. Thank you, Simon, for getting all of us together. We've known each other for far too long to know a lot of secrets about investing, your hacks, how do you read founders, even Abhishek for that matter. 4 or 5 years we've known each other. Even Shrishti, 4 years, I think. So 4 or 5 years. The room knows each other, so we'll let some secrets out today. Just a show of hands, how many of your founders here? 10%. How many of you are raising capital? Okay, okay. How many of you want to be founders? Okay, that's a good one. ठीक है, so we'll keep it like that. Uh, so just to set the context, I have gone through the journey of 0 to 1, raising capital, raising seed money, and then raising equity, growth stage capital, raising a lot of debt, all forms of alternate investments as well. And I see that I started my journey thinking about investors as people who don't like me. You know, a lot of you founders would be thinking that, "यार, पैसे क्यों नहीं देते? Our idea is so good. We have all the check boxes there. We're so passionate about our idea, but why do investors don't listen to us, or why are they not giving us the check to build the business of our dreams?" So Abhishek, quickly, we'll also keep it quick, rapid fire type of, just to get a lot of points covered, but take your time also, like get the thought going on. But होता क्या है, मतलब क्या चाहिए, what do investors really look in founders?
Okay. So, um, let's actually split this question in two parts. Okay. So one is, let's say if you're coming in early stage, right? Look, late stage relatively is relatively a lot easier, right? There's a lot of data to kind of prune and actually show that you're doing work and then take an informed call. So I was just talking about, late stage investing, right? When you have a lot of data about the company, you can churn data, you can understand the consumer, etc., a lot better, right? But when you're coming in a lot early, right, there is very limited data, right? There is very limited work that you can actually land up doing. So essentially the call is on three things. What's the, addressable market opportunity? Okay. What's your view on the founder and what's your view on the product, right? Essentially, these are the three parts that you kind of take a call on. Look, it's not easy, right? End of the day, it's a certain gut call that kind of comes in because in the absence of data, etc. So what any investor is kind of looking at that, look, from my fund, is this something that's going to be eventually making money for me? Right. Now, they'll do a lot of work around what are similar examples of, such sort of an investment opportunity, let's say in the West, etc., or anywhere globally. Can business models like this eventually make money, right? And third, uh, at least for me, very, very important that, look, how am I going to exit the business, right? Yes, the business has grown. Yes, it's making money, etc. But eventually, as a fund manager, the only way I kind of make money is when I exit the investment, right? So is it an exitable opportunity, right? Uh, if, let's say, for example, these three boxes get kind of checked, as an investor, I'm okay.
Do you have a weightage for three things you mentioned: the exit opportunity, founding team, and the TAM? Any
No,
weightage, or it's gut instinct driven?
I think bulk of the weightage for me, will go to the founder and the quality of the founder, etc. But
70-80% or less or more?
uh, look, I think two things are like non-negotiable for me. Number one is the founder quality, and the second is exit opportunity. The founder can be an absolute rock star, but if in a business which is non-exitable, so let's say, for example, again, I'm just taking a non-sexy sector, let's say chemicals, right? Chemicals inherently have existed for like 30 odd years, right? They keep growing, they make really good EBITDA margins, but there is no exit. Okay. So in spite of every other check in the box, if the exit is not there,
It's a very solid example, actually.
yeah,
It's a large TAM,
it's a
great founding team, but no exit opportunity.
Bharat,
No clear signs of exit
you will
opportunity.
you will be surprised. Just look at some of the specialty chemical companies. You will see consistently for 10 years ROCEs being like 25% plus, EBITDA margins being 20% plus, the growth being about 20-25%. But still there are no takers for businesses like those, right? Because there is actually no investment. There's no exit for that. I mean, you eventually then have to wait for the business to go to some 4-5 thousand crores, make that 500 crores EBITDA, and then you list, etc.
Interesting.
So
Very interesting.
yeah, that's what my view. So it's difficult to assign a weightage to answer your question, but yeah, I think these two things are non-negotiable out of the three.
Got it. That's a very good insight. So it's not always about the founding team and the idea. That's a very good point. Srishti, what about you?
I think, in addition to what Abhishek has already said, the one metric that we really care about is customer obsession. How well does the founder know the customer? Because ultimately, it's all fair to say that, you can raise money and drive up valuations, do multiple rounds and all that. But ultimately, you're building for the customer. So if the founder is not obsessed with the customer, then, there are very high chances that we'll say no to that. And also, in terms of the market opportunity, since Abhishek already touched on that, I think, there has to be a clear growth opportunity in that sector. And we have to see other examples of that breaking out as well, be it globally or in India. I think those are the two other elements that I would add to it.
Have you seen investors, not early stage, but I've seen like throughout the entire journey till late stage also, sometimes investors get the idea of TAM really wrong. Like Facebook is a great example.
That's a company that I worked at. And, if you I had asked Mark Zuckerberg if he was ever going to expand beyond colleges, he would have said no. That would be ridiculous, right? Because I want to build the best social network just for colleges, right? So if you ask that Zuckerberg in the, in the first few years of building that, they wouldn't have had a clue that they were going to become this giant of a company, which is like, top 7 companies globally in terms of market cap. So, if sometimes even the founders and the investors cannot have the imagination of knowing how good the good shall be. And those are things that you can only know as the journey plays out. So, more than TAM, honestly, it's customer obsession all the way. And that's what we're betting on.
It's solid. So exit opportunity and customer obsession. Sanil, what works for you? What do you look in?
Yeah, so we've always preferred coming in as early as it can be at Huddle. I can't agree more to what Srishti said. It's about obsession. I think obsession is a great uh, attribute to have in anything you do in life. I mean, it perseverance wins, right? I think if anyone agrees with me on that in the room, to persevere, you have to be obsessed. Um, and why do you want to persevere? Because, and I want to be very clear, you want to outlive your competition. You have to be hungry. You have to be absolutely ruthless as well in building with the right morals. But what we look at Huddle, in addition to obsession, is what do we bring to the table? Because we like coming in when it's wet clay, as we say internally. We have to know, what do we bring. Are we bringing the tools? Do we know the resources that will help even dry the cement? Can we do the real job for the operator? Because once the wiring of capital is done, let me just sort of conclude on this point with this bit, right? What is investing? Financial bits only come twice for the investor: entry, exit. Exit is circumstantial. To make the second happen, the founder works hard, the investor has to work hard. Only then does investment actually happen in this ecosystem. And we've all invested, and I admire my three friends here with the kind of way they add value. I think we have to work like the founder without steering the founder on where they should go. We have to trust the founder. We have to trust ourselves. We can't learn on the job because this is that person's livelihood. It is other people's livelihood. And then we have to also learn. I love the point that you mentioned about meta, right? And I've been wrong many times. My anti-portfolio joke is larger
I'll get
in
to that one.
yeah, and we've spoken about this because we sometimes we don't have a crystal ball. Let me be very clear. All we have is the tools to hopefully make a learning with the founders, and that's largely it. And lastly, we internally say we have to fight for a deal. You have to fight for the founder. Whether
Very rare, very rare.
yeah,
Very rare, but I mean, it's a quality that I think you definitely possess, knowing your portfolio companies and how you've looked at it. But also coming to the point now that, uh, So we'll keep the context to early stage investing. I think that would be the most relevant for the group here. Early stage investing is absolute art. I think all of you would agree. There's no clear, statistical point that can tell you that this will work or this won't work. And early stage investing in India, according to me, is still very, very at a very nascent stage. Uh, and be it the economic climate, be it the macroeconomic issues, we've gone through 2, 3 in the last maybe decade or so, 2 or 3 bull runs with early stage, and those bull runs have ended very quickly. They didn't go on for a long time.
Yeah.
In today's time, how do you look at early stage investing? There are very little deals happening compared to the gigantic size of this economy, and the ideas and the aspirations that we have for entrepreneurs. Very quickly, how do we solve for it? Also, maybe Abhishek can go for it, but also, how does a founder approach an investor to it, knowing it's really difficult to raise 0 to 1 money?
I think, look, first fundamental, there are two fundamentals for any business, right? Number one is growth and the other is profitability, right? Look, whether it is again early stage, mid stage, growth stage, late stage, right? I think there has to be a certain bent of mind, okay, that this business is going to be made with those two objectives in mind, right? Those two, I mean, I always call it these are the two dharmas of any business, right? Look, if there is a market opportunity, right? If your product is right, okay, if your growth hacking skill sets are good, you will get growth. Okay. I think one of the fundamental problems, since you kind of touched on, why, as compared to an overall Indian economy, there are very few early stage investments that are kind of happening. Uh, this is one point that I see missing is that bend towards profitability, right? How do you make a business fundamentally profitable from day one, right? It doesn't mean, look, whether you are making a profit or you're not making a profit, that's a separate issue, right? Uh, let's say, for example, if I'm selling someone this bottle of water, right? And if I'm technically losing money on every sale, right? No matter, even if my business grows 1000x from here, I will still keep losing money in the overall business, right? But let's say, for example, if in my head that, look, I'm going to sell like 100 bottles today, that maybe I'm going to make 1 rupee loss per bottle, but that's okay, because the day that I'm going to sell 10,000 bottles, I'm going to recover that cost, through volume, like some economies of scale, etc., right? That's a bent, or that's an approach towards handling a problem, right? I feel, look, last 2 years has gotten a lot of discipline when it comes to profitability, right? Streamlining business, streamlining costs, etc., all of that. And if, and trust me, in India, at least from a consumer perspective, I refuse to believe India is a cost conscious country, etc. I think it's the perception about value, right? Is a worth, right? I mean, technically, it is one of, I mean, in India alone, probably it clocks about the highest luxury goods sale, globally, right? So I refuse to believe something like that. I think what you need to be very clear is what value are you demonstrating to the customer?
Got it. Got it. Sushi, what do you think? Why are such less deals happening, and how should a founder approach, let's say you, what ticks you?
Well, Bharat, I actually disagree that there aren't enough deals happening. I think the nature of deals happening has changed fundamentally. I've been investing for the last 10 years. I would say there's so much more momentum in early stage now compared to what was happening all these years ago. A decade hence, you wouldn't be able to even connect with the funds, let alone, if you would meet angels, they would ask for 10% of your company for an obnoxious valuation. And those were the days, but like times have changed. There's so much more understanding in the ecosystem. There are so many entrepreneurs like yourselves who are giving back to the ecosystem, training the new generation of entrepreneurs. But what has happened is actually that the first round of funds that were raised, they've actually matured. So now they've all become institutionalized to a large extent, where they've receded into doing later stage rounds compared to very early stage bets that they would do initially. So the rounds which are usually between 500K to a million, I'm seeing a lot more angel activity happen where, a bunch of angels are coming together and pooling that round and making that happen, or even micro VCs. So the dynamics have changed. I actually think the deal activity is at an all-time high. What I'm actually worried about is the drop that will happen from pre-seed and seed going to Series A. Because historically, that's been the biggest decline point, and I think 80% of the companies don't even get to Series A. So, that is the stat that I'm more worried about.
And
than
that's
the
how the angels make
Series A.
money also. Can we
Actually,
al-
angels don't make money, no? If the company is not getting to
Of course,
Series
exactly.
B or
That's how what an
Series C,
angel would make
yeah,
money.
but
If you
money,
get to more
yeah, if you get to that
yeah.
stage is where you get money, right? So a lot of angel money is getting stuck in these years, which is why, angel sentiment is getting affected. And so you might see slowdown, but I think if you just look at it at an aggregate level, I don't think early stage activity has ever been this high, in my opinion.
I just have one data point on that. 2017-18, I don't know exact which the year was, and I remember reading this article. I think it was we had about 500 odd seed stage deals that year. I think last year we had about 1,200 or so in 5 years. The number of registered startups went from about 25,000 to about 1.75 lakh as of last year. So I feel like I mean, because I get maybe about 20, 30, and I'm not an active investor, I would do very selective deals. I get maybe, I don't know, 20, 30, 40, depending on the time of the year, inbox message with great founders. They're not able to raise capital. And why are we not sitting at 10,000 deals, seed stage deals a year?
Yeah, there are 3 points here that, and I'm gonna sound very opinionated, so be it. Okay, so I think one, there has to be the first problem has to be solved by the investors. Okay, what is the problem? That we keep indexing that 10 में से 1 चलेगा, 3 चलेगा, so suddenly it's a probability game. We have to create consistently good companies. I am of a firm belief that consistently good will beat seldomly great. Today, I don't know the stats. I don't frankly look at what my peers are doing. For me, what's important is 75, close to 80% of my founders have raised second, third, fourth round since we have entered. Am I creating a stable base of companies? That's important. Now, how do you do that? You have to have the risk taking ability. You have to have the infrastructure to help your founders. You have to have more peers who have late stage ability coming in early because they can complement. I think funds have to collaborate more. I think all four of us have that philosophy. I've had the privilege of working with Abhishek and his team, and I know they understand Z to A, we understand A to Z, and then suddenly we meet in the middle. I think that kind of collaboration has to start from funds. This competitiveness has to be a little, I mean, it can't come at the cost of fighting for a deal and not being able to see its potential. That's one. The second is to again what Srishti says, a very interesting data point that funds have matured to a level where they might have gone into becoming later stage funds. But what's actually happening is there are founders and incredible founders like yourself who have now can either start up again, can set up funds. So actually the kind of, or more importantly, the entrepreneurs that are coming out of these companies. So actually, I also don't think deal flow, and I'm very bad with the data sets. I don't know how your memory is unreal. I don't know what the velocity of the deals is. I think we're seeing way more than we had probably planned at in 2025 internally. And I think that's because of the maturity of founders has changed. Now, on the funding decrease from pre-seed seed to Series A, I think it's again another point that investors like ourselves have to improve. And this is something I can put my hand up and say Huddle has to also improve on it dramatically, which is have more patient capital in your pool. And again, I can attest to it that folks like RPSG are doing it. They're coming in earlier, they're stretching the company. And I think, Bharat, you with your experience of having built not one, not two, but three organizations, know what patient capital can do. It basically allows the founder to do what we were talking about earlier is persevere. And I think we need to extend that helping hand and be a little more patient
I
as
need
well.
more of you in growth stage and lead stage capital. But
I only do one of these three things, so we need more of someone else.
okay, so now coming to the point, I think these are very, very valuable inputs. I got some very fresh perspective on this. Uh, Abhishek, what do you look in a founder? Can you describe the the I don't know, the perfect founder कैसे approach करते हैं, what do they do, what do they say, how do they walk, how do they talk, how do they look at you. Because I'll tell you what I have done. I've never looked at a pitch deck. पता नहीं होता नहीं मुझसे. I will just ask them to talk, maybe go for a walk in the evening with them, maybe have, go for a gym session with them or just have dinner with them. And maybe I'll take 3-4 months. And if the deal goes, it goes. I'm okay with that. But बंदे के साथ काम करने में मजा आना चाहिए. अगर वो फोन करे कभी तो ऐसा ना लगे कि यार काम है. Should be like fun. And that's the fun of early stage investing, but it's my own capital. I'm not playing with someone else's capital. I had the liberty to do that. But what do you look in a founder? Do you have this profile of a great founder you would not never miss?
Yeah. Ah, profile of a great founder. Look, honestly, I never thought about it, that way. But I'll give you a little bit of unstructured, sort of, answer to this question. See, I think first and foremost, right? I think one of the qualities that I look for any founder, the person has to be adaptable, and the person should be willing to learn, right? Uh, Look, no matter how much of a rock star the guy is, right? No one can predict, right? I've been investing for almost 20 years now, and I've looked at, I think, 5,000 odd companies. Other than one, I have never seen business plans being met, right? So I think it's part and parcel, and I think that's the experience with all the four of us, right, around here. Now, see why it doesn't get met. It's not only a function that, look, just because I want a higher valuation, I'll kind of bump up the numbers, etc. Certain things you can't predict, uh, right? Now, is the founder adept to learning and unlearn and then kind of change course, right? Does the founder possess at least that amount that he or she would not let, that ego kind of come in and say that, look, this is what I went on to, build. But for whatever reason, if I'm not getting success here, and if there's a easier and a larger opportunity kind of sitting anywhere, it's okay to change courses.
Can I also just maybe change the question a little bit to what are there any red flags also that you want to call out? Because I think as an early stage founder, I've been through that journey where I don't know yaar ki how should I approach them? Do they like cold reach outs? Do they not like? Do they like references? Do they want a pitch deck which is very well made, or do you just want like a Travis kind of a pitch deck which had 5 slides and some,
See,
you know?
Bharat, I think, look, I can't talk about all investors in general because everyone has their individual personality. Uh, Pitch decks looks similar to what you mentioned. It's not, I look at pitch decks for a very different sort of a reason. So, see, one of the things which I always ask the founder, you explain your business to me in one line. Okay. If he or she is unable to do that, which means I'm not sure if the founder actually understands the business that clearly.
Do you like simple
Completely simple.
businesses? Yeah.
Completely. See, at least let's say the product that we are in. Okay. Again, uh, we invest in consumer brands, right? I mean, bread and butter, etc. How difficult is it to explain someone that, boss, I am selling you this bottle of water, right? It is not rocket science, right? My answer would be different if I would be doing like deep tech, AI, etc. Probably I'm not that smart enough, so I don't even try going into that space. But explaining to me why a bottle of water would make sense for a customer, what's the pain point that I'm kind of solving, and why the customer is going to give me a certain premium for this, and hence I'm going to make money, is not difficult.
Do you also then like founders who are brutally honest to you about everything?
100%.
So big point for everyone. I think a lot of early stage founders want to sugarcoat everything.
No, look,
Yeah.
one thing I can talk for investors in general because they're smart, right? They'll look through
Your shit.
easy, right? It's better to tell them that, look, there are, I mean, these are 10 things that are required to kind of build the business. I figured out the first 3, and I'm really good at these 3, and I'm going to crack it. बाकी का साथ बाद में देखेंगे. And trust me, a- amongst all the friends that I have in community, 90% of them will say, okay, fine. I mean, they'll actually like that response a lot more than, look, I figured out all the 10 things.
Got it. Shrishti?
Yeah, I think coming to red flags is interesting because what founders also have to remember is that investors are always talking to each other. They're also talking to places where you've worked previously. They're talking to your past employers. So we do so many reference checks that, if you say anything while you're pitching, which is not authentic, it will come up in those conversations, right? And it's better to hear always from the founder directly rather than be caught by surprise by something that comes in the reference checks when we're doing those on the founder. So if you're not being authentic during the pitch process, it will show up. And you have to remember that it's not just one date you're going on, right? It's like a 10-year marriage at the very least. So if you are going to lie on the first few dates and get away with it, it's not a big win, honestly. It's actually doing a disservice to your own company if you were trying to get away by like a hack or something in the first few conversations. And then, softer things like, how much money has been spent on the business? Is this founder actually paying attention to the fundamentals and unit economics, even if it's not monetizing right now? Is he or she going to be capital efficient enough to be able to make this a real business ultimately, right? And last thing, I think integrity is very, very high because if there's anything that comes up, be it in your numbers, and I've heard so many pitches, as investors, you also have to remember that we are talking to 1,000 or 1,500 startups in a year. And, at some level, your intuition gets refined. So you are able to catch hold of things which become very obvious, which might not be very obvious to the founder who's pitching. So, these kind of red flags become very evident in pitches. And those are some things to keep in mind.
Sanil?
Yeah, I think I'm going to give you 4 examples that came from what they've said. And it really takes me back also. I'll give an example of a company we backed, Day Zero. It's a company called Bold Care. Now, when Bold Care started, the founder was literally walking out of his last day of work, had the chance of sitting with Rajat. He sat down and clearly could map out how his company will get built, clearly knew what pivots that will be needed, spoke about marketing activations. Maybe 3 out of 10 things have happened in their journey. But he was so obsessed about it. He could have easily said, I need to take a day's break, a week's break. I've gone through this long, you know, journey and he went from VC to building Bold Care. But he was obsessed. And then he listened to me about what my thoughts are. So therefore, he was looking for perspective. Obsession and assessment came in that meeting. We were lucky, we backed him, and we continue to back everything he wants to do. Frankly, today, and I say this about all their founders, and any good founder you back, they can want to go from business A to business B, you'll back the person. You'll continuously keep backing the person. Secondly, how do you adapt with the times? Um, Blutica is a great example for us over there. COVID came, it was a cafe business, and they adapted incredibly well. I think, I believe Matt was here earlier today, and I'm sure he would have given his perspectives. And for us, you have to have faith again, right? When we spoke, and frankly, for us, we really doubled down in that point. At Huddle, we really put in, we, with all our faith, more capital in the company because how obsessed about the customer, again, something that Srishti was talking about, customer obsession came out. And therefore, if the customer is there offline, how will they come online was completely mapped out. Again, a lot of visualization. I think great founders know how to visualize scenarios and are not obsessed about how do we get there. They're willing to go the longer route or the shorter route if it's the right way. The third example is a red flag without taking names. Founders that get swayed by what competition is doing, not realizing why the competition is doing it. And we have lost and had write offs. One in particular where circumstantially the founders moved. And of course, I still think that it is the investor's responsibility to do some diligence, to guide them about perspectives. But I think sometimes when you move away from what your core business is because someone else might suddenly have overtaken you, you have to realize that, like a track on a curve, sometimes they're not ahead of you. At some juncture on the curve, you will overtake them. So I think those founders that have get taken away from their goal because someone else is doing it faster, it's okay. Frankly, industries where you have competition overtaking you at a certain amount of time might actually help you grow. It'll teach you more. First mover advantage is not everything either. And to your other point, I think to everyone here who talks to investors, question your investor. This industry is nothing without founders. So again, I'm going to say something that people might not agree upon, but I think this ecosystem is. I love reverse pitches, like the concept of reverse pitch. You have to fight for your founder. So ये होता है कि आओ pitch करो. I love founders. 8 out of 10 founders today are asking you your thesis first. And I think that's important.
Amazing.
That is important.
Never used to happen, yeah.
Yeah, and it's completely, I mean, it's
It's nice.
yeah, it makes us question, how do we really understand? Go prepared for a meeting.
Yeah.
And I think that things are evolving for the best.
Such solid points there. Uh, I'll come to the last bit of this and then maybe open it up for the audience. You all touched upon how the investors also need to sort of amp up, like, get questioned, and uh, just be a little bit more fair. Diligence and all of that also becomes a part of it. But early stage investing is a lot to do with, for most investors, is a paint and pray, sort of a spray and paint approach. Uh, Founders, on the other hand, would dedicate 5, 7, 10 years of their lives. For them, it's their lifeline, it's their business. They are in it. It's their everyday thing they do. I have had the pleasure of meeting some amazing investors, working with them, who just think like that. That okay, we are investing in 20, 25, 30 companies, but let us also deep dive with all of these founders and have that relationship where they don't feel as if we are have, like, even if you die, we don't care, sort of a thing. But there are situations where that happens. I've had founders who would mail their investors that nahi ban raha, band kar do. Uh, you know, it, we don't want to take your baggage with us, and it has happened in the past. It may be happening less now, but in the last 12, 13 years of VC angel investing in India, how does a founder balance their relationships with investors, and especially when things don't go well? If a company is going north, north, and north, I don't think these conversations even come up. But most companies would never go north, north, north.
Yeah.
What happens? How does a founder deal with the investor? Should an investor deal with the founder in such a situation?
Um, Firstly, I think the relationship between an investor and a founder is very similar to that of our husband and a wife. Okay. Um, there's respect on both ends, but there's fear also on both ends, right? Uh, Secondly, I think, like marriage, I think the communication and transparency has to be super clear, right? If there is one thing that I can pick up, between any relationship, is how transparent and how clear the communication is between the two. And that's the example that I'd given, last time as well. Let's say, at least with our founders, we are very, very clear on this thing that, look, our expectation from you is not that, you'll end up growing 10x every year, because in my view, that's not sustainable, right? I am okay with a year of no growth, right? As long as, there's something else which is being built up, which is, which kind of strengthens the backbone of the company, right? I'm also okay with, realizing certain losses on the balance sheet, etc., and not at the expense of window dressing. Okay. It's completely okay to report, certain things which have not gone out in the balance sheet, because let's say the moment you window dress something, right? If not in the next couple of years, in the next 10 years, 100% it's going to come and bite you. Okay. So managing that communication at all points of time, right? I think, see, one of the issues that happened over the last 3 years, um, uh, leave, let's say, the last 1.5, 2 years, when, probably there was a dearth of, there was a slightly winter of capital that was coming. But let's say prior to that, few years, right? I think the issue was there was just too much capital chasing too few names, right? And we've all experienced, something like this. Now, what's happening? The investors funding the founder is trying his best to grow because the valuations were like through the roof, and he has to justify a certain business plan that he has shared, right? And then all of a sudden, like after like several months or probably a year or so, and they come and say, boss, money is over, right? I need more money. And the investors wondering, dude, I just gave you so much amount of money. Money probably, the business has only grown from X to Y, etc., right? I don't think so. There was a clear communication at both ends, and both the parties need to be blamed for something like that. It's not the founder alone, it's not the investor alone.
Because in most cases, reporting is also very tight. Founders have to do, and that's the duty, not just the fiduciary, but also moral duty of the founder and the promoter, to report
Totally.
everything to the board and to the
Totally.
investors.
And I think, look, Bharat, it goes both ways, right? Uh, Look, I think it's really, really difficult for an investor to manage a portfolio of 40, 50 companies actively, right? So the responsibility is both ways, right? Yes, the founder has to share, certain information transparently, correctly, with full integrity, etc. But then it's the role of the investor also, right? Because if actually they are also managing someone else's money in most of the cases, right? You need to actually read through those numbers. You need to read through those board presentations, etc. You need to ask the right question. Even post doing the investment, there is a certain amount of diligence that you need to do. I don't want to name companies, but let's say, for example, if someone goes and says that, I've opened 600 garages, or let's say 600 companies, etc. Dude, I can't believe that, there are like investors sitting on the board, and no one has a clue that like half the stuff are like fictitious. It's impossible, right? So I think the responsibility goes both ways, but the communication has to be transparent and clear.
Very valid points. Sushti, what do you think?
In addition to what Abhishek already said, I think, managing expectations is the key pillar of this relationship between a founder and investor. Oftentimes, what happens is that the investor has certain growth expectations from a business that the founders need to be able to meet. Otherwise, the investor will automatically deprioritize the company in their portfolio. And it's the nature of the business, right? Because ultimately, you have to prioritize companies and you have to do pro rata in those companies which are growing and have the potential to grow, because ultimately that's how you will return money back to your LPs. So founders also have to understand that investors are also building their own businesses, which is the investment management business, where they ultimately have to go and return the money to the LPs. So if the expectations are not clear in terms of how much growth are you going to be able to deliver and what is the right growth metric to be even looking at or tracing, then often these miscommunications happen, and founder integrity issues come up, or sometimes there are things where window dressing is happening. There's things like opening up many stores, which is not actually the ground reality. So those kind of things then start cropping in, which is completely unnecessary. If you get the right partner for your business who is aligned on expectations in terms of this is where you will be in 3, 5, 7 years, then it's a much easier conversation to have, rather than being caught up in a surprise 2 years after you've taken money from them and you're not growing as fast, and they have deprioritized you in their portfolio.
Got it. Got it. Sanil, any points?
Yeah, just a quick one, and which is that I think over communication is very good in the early stages. When we come in, we've been a part of literally figuring out branding, naming, first hires, first loss, first win, and I think therefore over communication is important. We follow the same practice for the capital we manage, be it of large institutions that have backed us or individuals. We over communicate, and I think therefore you don't get some two things happen. They're not surprised, and they can probably see where they can help. And that's the same thing. A founder over communicates. You can gauge where you want to get involved or shouldn't. I think that's also very important for an investor to not get involved. And sometimes our investors do the same. Our larger LPs, etc. Um, what is very important in over communication is also, and something I ask, and again I'll openly share it, is how do you as the founder slash founders want to make capital? What is your, is it what motivates you? I think it's a big question to ask. Is it power? Is it fame? Is it capital? Is it exit? Is it acquisitions bana karni hai? Bolo. Because then how do you align your exits? Because we manage capital. It's our fiduciary duty to return capital and way more, to align it. I have had 3 examples and I wish I could share them openly, where founders have helped us generate returns because they've understood us, we've understood them, and they have also done well. And I think that over communication, this sounds like a friendship. And yes, dude, therefore like a marriage. I just want to say one quick thing on the earlier question you asked about great founders, and I do want to mention that incredible founders are people who have the ability to hire and attract talent. That is something. So, how can they attract someone that is way smarter than them in domains? That's a big read for me personally. I forgot mentioning it.
That's a big one here. Okay, so closing sentiments, but just before that, I want to do a quick rapid fire for myself and also for the audience. You all three have to name one company in your entire portfolio.
Only one.
Only one.
Only one.
And ideally the one that you regret missing the most. Lenscard. Lenscard, okay, it's a big one.
Zepto.
Oh, God.
Blue Smart.
Okay. This is so good. Thank you so much.